Imagine this. Every month, you set aside $500. No lottery win. No rich uncle leaving you an inheritance. No high-paying Wall Street job. Just a simple, consistent habit. Fast forward 30 years. You log into your investment account. The screen loads, and you see 7 figures, over $1 million, sitting there. It feels impossible, right? Like a trick, or maybe some kind of get-rich-quick scam. But it's not magic. It's not luck. It's math. It's patience. And it's a little financial phenomenon that Albert Einstein once called the eighth wonder of the world. In this video, I'm going to walk you through how $500 a month, the cost of a daily coffee and lunch combined, can grow into $1 million portfolio. We'll break it down step by step, run the numbers, look at real-world examples, and most importantly, show you exactly what you can do to make it happen. So, grab a pen, because you might just want to write this one down. Before we talk about how, we have to understand the engine that makes this work, compound interest. Let's start with the basics. When you invest money, you earn returns, maybe from stock price growth, maybe from dividends, maybe both. That's your first layer of growth. But here's where the magic happens. In the next period, whether that's a month, a quarter, or a year, you're not just earning returns on your original money, you're earning returns on the returns you already made. This snowball effect is compounding, and over time, the snowball gets bigger and faster, turning small amounts into massive sums. Let's put numbers to it. You invest $500 every single month into an index fund that grows at an average of 8% per year. Historically, that's roughly what the S&P 500 has returned over decades, even with all the ups and downs. After 1 year, you've put in $6,000 of your own money, and you've earned around $260 in returns. Not that exciting. After 5 years, you've invested $30,000, and your account might be around $36,000. Still not life-changing. But after 20 years? You've invested $120,000, and your account is pushing $275,000. And after 30 years? That same $180,000 you personally put in has grown to over $745,000. That's an extra $565,000 that you didn't work extra hours for. It came from your money working for you. And here's the kicker, the growth is not a straight line. It's exponential. In the first 10 years, you might feel like this is going nowhere. But in the last 10 years, your portfolio can grow faster than in all the earlier years combined. That's why starting early matters so much. Every year you delay, you're not just losing 1 year of contributions, you're losing the decades of growth those contributions could have had. Alright, now let's answer the $1 million question, literally. How do you turn $500 a month into $1 million? It comes down to 2 levers, your rate of return, and your time in the market. Let's look at scenario A. You invest $500 a month at an 8% annual return for 30 years. Final value? Roughly $745,000. Solid, but short of the million. Scenario B, same $500 a month, but you manage to get a 10% average annual return, maybe by using a low-cost S&P 500 ETF or adding some growth-oriented assets. After 30 years? You're at around $1,088,000. You've crossed the million mark. Scenario C. Stay at 8% annual returns, but extend your investing horizon to 35 years. That brings you to about $1.2 million. Here, time, not higher returns, is what gets you past the goal. What does this tell us? To hit 7 figures, you either Earn slightly higher returns by keeping costs low and choosing the right investments. Or, more reliably, start earlier, give compounding more years to work, and let time do the heavy lifting. And here's the takeaway: time in the market matters more than timing the market. Even if you started during a bad year, staying invested beats trying to jump in and out to catch the best days. In fact, missing just the 10 best days in the market over a 20-year period can cut your total returns almost in half. If you want this plan to work, your choice of investment matters, but maybe not in the way you think. For most people, the best option is a low-cost, diversified ETF. Here's why. 1. You get instant diversification, hundreds or even thousands of companies in a single purchase. 2. Fees are tiny, often 0.03% to 0.1% a year, which means more of your returns stay in your pocket. 3. You don't have to constantly watch the market or pick winning stocks. Let's look at a few examples. S&P 500 ETFs like SPY, DOO, or IVV, historically around 10% annual returns over the long term. Global equity ETFs like VT or VWRA, spread your risk across markets worldwide. Dividend ETFs like SCHD, which not only grow but also pay you regular cash dividends you can reinvest. The key is to choose broad, diversified funds instead of chasing the hottest stock of the year. That keeps your risk lower and makes it easier to stick with the plan during rough markets. Remember, the investment vehicle is important, but your discipline to stay invested is what makes the million possible. Now, let's be honest. The math is easy. The formula is simple. But in real life, the hardest part of this million-dollar journey isn't the calculations, it's your mindset. Here's the truth: over a 30-year period, you will see multiple market crashes. Not might, will. The stock market will drop by 10%, 20%, sometimes even 50%. When that happens, your account balance will look like it's shrinking before your eyes. If you've invested for 10 years and suddenly see half your portfolio's value wiped out, it's natural to panic. But this is where most people fail. They sell when they're scared, locking in their losses. And then they miss the recovery, which, historically, always comes. Legendary investor Peter Lynch once said, "Far more money has been lost by investors preparing for corrections, or trying to anticipate corrections, than has been lost in the corrections themselves." And Warren Buffett put it even more bluntly, the stock market is designed to transfer money from the active to the patient. So, what's the lesson? If you want to reach that million-dollar mark, you must train yourself to stay invested during the storm. In fact, those are the moments you want to keep buying, because you're essentially purchasing shares on sale. Think of it like shopping. If your favorite store suddenly had a 30% off sale, would you refuse to buy? Of course not. So why treat the stock market any differently? If you commit to investing every month, especially when things look bad, you're positioning yourself to benefit most from the recovery. And over decades, those recoveries are what turn ordinary investors into millionaires. Before we wrap up, let's talk about the pitfalls that can sabotage this plan. Mistake number 1: stopping contributions during downturns. This kills your momentum and delays your million-dollar target. The best prices often come during the worst news cycles. Mistake number 2: chasing hot stocks or trends. Yes, it's tempting when you hear about someone doubling their money on a meme stock. But most of these stories end badly. Consistency beats speculation. Mistake number 3: paying high fees. A 1% management fee might not sound like much, but over 30 years, it can cost you hundreds of thousands of dollars. Always check the expense ratio of your funds. Mistake number 4: trying to time the market. Even professional investors fail at this. Your focus should be time in the market, not perfect entry points. Avoid these, and you'll already be ahead of most investors out there. So here it is, the entire formula, $500 a month. Low-cost, diversified ETFs. The discipline to keep investing through thick and thin. And the patience to let compounding work its magic for as long as possible. It's not glamorous. It won't make you rich overnight. But it's one of the few strategies in personal finance that works in almost any economy, across generations, for ordinary people who stick with it. Your future million isn't built on one lucky day, it's built on thousands of ordinary days, where you quietly, steadily, put your money to work. If you found this video helpful, hit that like button, subscribe, and check out my next video. Because your journey to wealth doesn't start someday. It starts with your next $500.